PantheonAI presents PantheonAI Podcast, April 22nd. Welcome to the PAI Morning Briefing.
And good morning, everyone. I'm your co-host, joining you from PantheonAI.
That's right. It's April 22nd, 2025, and I'm delighted to have you with us as we navigate through the intricacies of our global financial landscape.
We've got quite a bit to unpack today, haven't we? From a quick market overview right into a deep dive on trends that are really shaping investment decisions right now.
Absolutely. So grab your coffee, settle in, and let's get right to it. Let's start with that quick market snapshot.
Sounds good. This morning, the S&P 500 is sitting at roughly 5,234. That's showing an increase of a bit over 0.5%.
Okay, modest gain there. And the Dow Jones Industrial Average?
Trading near 38,750, up by approximately 0.6%.
All right, NASDAQ, the tech bellwether?
That's at around 16,146, with an uptick of nearly 0.4%.
So all the major indices are seeing green, even the small caps.
Yeah, the Russell 2000, our gauge for smaller cap stocks, also modestly increased. Its current value is roughly 1,867, showing a slight rise of about 0.2%.
Interesting. So traditional equities are showing some resilience today. What about crypto?
Crypto is having a more vigorous morning. Bitcoin's price has reached nearly $90,468, marking a robust increase of over 3.3%.
Wow, that's a jump. And Ethereum?
Ethereum is trailing a bit, but still up nicely, near $1,653, which is up by about 4.6%.
Okay, so a mixed bag then. Modest growth in equities, but strong momentum in cryptocurrencies. It really feels like investors are still split, doesn't it?
Totally. They're divided between those safe bet blue chips and the high volatility digital assets that, could offer huge gains, but also significant swings.
Exactly. Now let's take a deeper look at some of the major market trends influencing investor sentiment. One big one is the warnings we're hearing from the International Monetary Fund.
Right. Their analysis paints a pretty clear picture. Trade fights could really impact the global economy, not just the U.S. if they continue.
Yeah, prolonged trade wars could really sap economic growth and push inflation higher throughout the year. And that means policymakers and central bankers are watching trade policy disagreements very carefully.
Because of the cascading effects, right, on consumer spending, manufacturing output, even global supply chains. And while the indices are up today, that undercurrent of uncertainty suggests markets could face some choppy waters if global tensions persist.
Definitely. And adding to this mix is news from the aerospace sector. Companies like RTX and GE Aerospace are bracing for a tariff impact exceeding $1 billion.
Wow, $1 billion. Tariffs have never been a small thing for industries with complex supply chains, but that number really underscores the ripple effects of protectionist policies.
It really does. And honestly, even with these serious numbers, it's hard not to chuckle a bit thinking that tariffs, which feel like a relic in our digital world, can still make boardroom meetings feel like a round of high-stakes poker.
Ha! That's a good analogy. And speaking of tariffs, let's not forget the consumer goods sector. Kimberly-Clark, the parent company of Kleenex and Huggies, recently adjusted its full-year profit growth outlook downward.
And the reason? Supply chain costs surging because of tariffs. It seems even everyday household products aren't immune to these international cost pressures.
It really makes you wonder, when was the last time you truly appreciated how a tariff could affect the price of your tissue box? Probably not until you had to do some real number crunching for your budget.
Exactly. Switching gears for a moment, let's talk about Halliburton. The oilfield services giant has seen its stock falter.
Yeah, primarily due to weak oil prices, which led to a decline in their North American revenue. They saw a notable year-over-year drop there.
And that really serves as a reminder that energy markets can be incredibly volatile, and a downturn in oil prices has a domino effect on companies tied closely to that sector.
Definitely. So these stories together paint a really layered picture of the market. On one hand, we have indices and crypto showing gains.
Right. But on the other, we see these structural issues like trade wars and sector-specific challenges that could potentially undermine broader economic stability. It's a fascinating interplay.
It really is. It makes things interesting for investors and traders alike. Now let's delve even deeper into these themes and see how they're affecting different sectors. Starting with technology.
Okay. Nasdaq's performance this morning might be seen as a harbinger of both opportunity and caution. The tech industry is always at the forefront, but it's facing headwinds now.
Headwinds like potential disruptions in global manufacturing supply chains due to tariffs and regulatory uncertainties in different places.
Yet, despite that, tech remains a beacon of transformation. The pace of evolution means companies can often innovate out of adversity, turning challenges into advantages.
True. And let's be honest, like our favorite smartphone needing an update to fix a glitch, tech problems often lead to improvements. Who hasn't had to reboot a device at the worst possible moment?
Haha, guilty. Over in the energy sector, the story's a bit different. Halliburton's struggle due to weak oil prices really shows how sensitive energy stocks are to global commodity markets.
It does. That drop in revenue for a company so tied to oil services underscores that with every shift in the energy landscape, there's potential for both risk and reward.
If you're an investor in this space, it's probably a good time to ask if these price adjustments are just a temporary blip or a sign of deeper changes.
Exactly. And with recent trends and the push for renewables, energy companies are facing this dual challenge, managing short-term volatility while positioning for a long-term transition. It's like juggling flaming torches.
What an image. Turning to the financial sector, the IMF's warnings about economic sagging from trade wars definitely strike a chord.
Financial institutions are on high alert because trade tensions can disrupt credit, increase borrowing costs, and create overall consumer uncertainty. That all cascades down to the banking industry.
But even in this challenging environment, there's opportunity. Banks that are nimble and adapt quickly might find themselves well positioned to capture market share during turbulence.
It's a reminder that, much like a game of chess, sometimes the most strategic moves are made during challenging periods.
Good point. Another angle is the ongoing impact of tariffs on global supply chains. The news about RTX, GE Aerospace, and Kimberly-Clark really highlights this critical theme.
Yeah, it's a reminder that seemingly isolated policy decisions can have far-reaching global repercussions. Tariffs designed to protect domestic industries can sometimes cause unintended ripple effects.
Absolutely. They can lead to decreased competitiveness on a global stage. Multinational companies have to balance maintaining supply chains across continents with managing increased costs that ultimately mean price hikes for consumers.
Let's face it, nobody enjoys paying more for essentials, but these disruptions often stimulate innovation as companies scramble for cost-effective solutions.
That's true. Maybe in the long run, we'll see a wave of creative restructurings that lead to a more robust supply chain network, assuming companies can innovate under pressure.
Hopefully. Now let's take a moment to consider the broader global market implications. The interplay between domestic fiscal policies and international trade disputes is always a delicate dance.
It really is. With the IMF cautioning that prolonged trade wars could drag down growth worldwide, there's a palpable sense of caution among investors. Global markets are so interconnected.
Yeah, a shock in one region can quickly propagate. If trade wars continue, we could see declines not just in major economies like the US and Europe, but also slowdowns in emerging markets that depend heavily on exports.
That ripple effect is something all investors need to be mindful of. A crisis in one part of the globe can lead to a repricing of risk everywhere.
From a macroeconomic perspective, government actions in response to these challenges are key. If we see a coordinated effort to mitigate tariff impacts, or if central banks adjust policies for inflation,
markets could stabilize surprisingly quickly. Conversely, a lack of decisive action might exacerbate trends, leading to more pronounced contractions.
It's that classic case of uncertainty breeding both caution and opportunity. A paradox that's fueled countless debates among financial analysts like us.
Exactly, and experts across multiple sectors have been vocal about the need for strategic adjustments in this environment.
They suggest investors remain agile, continuously revisit portfolios, and diversify across sectors to hedge against potential fallout from prolonged trade disruptions and weak oil prices.
So in tech, while some worry about supply chain delays, others see opportunities for emerging players filling gaps. In energy, low oil prices are tough for service companies like Halliburton, but they also create affordability that could eventually bolster demand and spur efficiency innovation.
And in finance, that cautious optimism from potential policy interventions could translate into more strategic investments as banks safeguard their positions amid volatility.
I find it particularly interesting, and maybe a little ironic, that as we discuss these high-stakes financial maneuvers, there's this underlying current of humor.
Oh, you mean like tariffs becoming dinner table banter among economists? Yeah, it's kind of funny when you think about it.
Right? It's like every shipment or box of tissues carries not just goods, but a subtle reminder of our global interconnectivity. It's that blend of gravity and levity that keeps our discussions balanced.
Well said. Before we wrap up, let's quickly revisit our key news items just to make sure we haven't missed anything.
Good idea. First, those repeated warnings from the IMF about potential sagging economic growth and rising inflation if trade wars persist. That resonates deeply given our interconnected economy.
Definitely. Second, the aerospace giants, RTX and GE Aerospace, bracing for that billion-dollar-plus tariff impact. That's a clarion call to the entire industry about the costs of political decisions.
Third, the Kimberly-Clark story, cutting their growth outlook because of supply chain challenges amplified by tariffs. Even Kleenex isn't immune.
And fourth, Halliburton's stock suffering amid weak oil prices, reflecting the energy market's volatile nature. These themes keep resurfacing, showing how integral they are to understanding where markets are headed.
It's interesting how each story reinforces this central theme. Economic indicators, tariff policies, and sector-specific challenges are all part of one larger narrative.
Exactly. It's driven by this dynamic mix of policy decisions, market sentiment, and unexpected challenges. We have to ask, how long will these headwinds last? What strategic measures can buffer their impact?
And how do these seemingly discrete events converge to create the broader tapestry of the global economy? It's complex.
Moving back to that detailed sector analysis, technology companies keep pushing boundaries, but they're not immune to supply chain disruptions and trade uncertainty. Many are reevaluating their strategies.
In the tech world, problems are often seen as opportunities, right? A chance to hack the system and make something better. It's a perpetual cycle of trial and error.
Right. And while today's NASDAQ uptick might be modest, the underlying investments in R&D, cloud, AI, cybersecurity, those are likely driving the next wave of growth.
And if you're ever frustrated by a system reboot during a call, just remember, even in chaos, there's opportunity and a little humor helps.
Good point. Over in energy, weak oil prices have profoundly impacted companies like Halliburton. It's a clear reminder that energy cycles can be as unpredictable as the weather.
When oil prices plunge, companies depending on robust demand are in a bind, like that friend who forgets his umbrella on the rainiest day.
Ha! But this downturn might also pave the way for a broader energy transition. As fossil fuel prices waver, we could see an accelerated push toward alternative energy investments.
That shift could create a more resilient infrastructure. Are we on the cusp of a new era, or will the old guard dominate? Only time and careful investor scrutiny will tell.
The financial sector is also feeling these tremors. With the IMF urging caution due to potential inflation and slowing, banks are in a delicate spot.
They have to navigate this tightrope between ensuring liquidity and protecting themselves from volatility due to policy shifts. Many are focusing on diversifying portfolios.
It reminds me a bit of planning a family vacation. You hope for clear skies, but you pack an extra umbrella just in case. Here, that extra umbrella is strategic hedges, diversified assets.
That's a great way to put it. Lastly, the consumer goods sector offers unique insights. Kimberly-Clark, facing increased costs due to tariffs, shows the tangible impact on daily items.
Yeah, it's not every day you hear a box of tissues might cost more because of international trade policy, but that's the reality. When supply chains get expensive, companies pass costs to consumers, stoking inflation.
It makes you wonder how much of our everyday spending is quietly being reshaped by these large-scale economic forces. It's fascinating, this hidden connection between global politics and our daily lives.
It really is. Stepping back, it's clear the current environment is one of both challenge and opportunity. Global market implications are profound.
Trade wars, tariff impacts, shifting behaviors, they're not isolated. They're interconnected drivers that can reshape investment strategies worldwide. Investors have to revisit old assumptions.
Is this temporary, or are we seeing a new, more uncertain financial landscape emerge?
Expert insights are unequivocal. Diversification, agility, and willingness to innovate are key. Think about tech's reliance on supply chains or energy's pivot to renewables.
Even in finance, where risk management is paramount, a forward-thinking, flexible strategy might be the difference between weathering the storm and being swept away. These aren't just abstract ideas.
They're real strategies that could define portfolio performance for months, even years. In closing today, I want to leave you with some thought-provoking questions.
Okay, hit us.
How will continued trade tensions and escalating tariffs redefine supply chains that once seemed inviolable? Are the modest gains in our indices a sign of resilience, or just a mirage masking deeper issues?
And perhaps most importantly, in a world where a simple tariff affects everything from Aerospace to Kleenex, how do we, as investors and traders, build a strategy robust enough to navigate this labyrinth?
As I reflect on today's insights, one thing is clear. In times of uncertainty, being informed is our best asset. As you evaluate your portfolios, remember every challenge, every fluctuation, is an opportunity.
An opportunity to reassess, recalibrate, maybe even uncover hidden potential. We encourage you to keep your eyes and minds open, ask questions, challenge assumptions.
And never hesitate to engage with our PantheonAI copilot for deeper insights.
Before we sign off, let's quickly recap the key takeaways. We started with that brisk market overview, indices showing modest gains, crypto having a robust performance.
Right. Then we looked at the structural challenges, IMF warnings on trade wars, the real-world tariff impacts on aerospace, consumer goods, and energy.
These stories are woven into our daily lives, reminding us that policy decisions far away have tangible repercussions for our own economic well-being.
In our sector analysis, we dissected tech, energy, financial services, and consumer goods, each facing unique challenges in this intricate landscape.
And globally, these trends aren't isolated. They're interconnected. It's essential for investors to stay nimble, informed, and ready to adjust strategies as the world evolves.
I want to give a special shout out to PantheonAI, your information copilot. This is the kind of cutting-edge support that empowers you to make sense of these complex dynamics and guide your decisions.
And remember, every good market discussion is best seasoned with a touch of humor. Sometimes when the financial world throws a curveball, all you can do is smile and say,
Well, at least I don't have to worry about my tissue supply getting taxed.
Ha, exactly. As we wrap up, ponder these questions. What strategic approaches can you adopt to guard against inflation and potential downturns? Are today's modest gains sustainable?
And in your personal journey, how do you balance the excitement of opportunities against the challenges of global uncertainty? These aren't just academic questions.
They should form the basis of your analysis as you strategize. We'd love to hear your thoughts. You can always reach out to our AI copilot here at PantheonAI for deeper insights.
Until next time, stay informed, remain agile, and keep a touch of humor in your approach to the markets. Join us again tomorrow for another in-depth episode of the PAI Morning Briefing.
We'll continue exploring these complexities with the same passion and detail. And always remember, learning shouldn't feel like a full-time job.
Thank you for tuning in.
And have a fantastic day ahead. PantheonAI, your information copilot.
Because learning shouldn't feel like a full-time job. Take care and see you next time.